In Chapter 13, we cover the statement of cash flows. So the purpose of the statement of cash flows is to show information about what happens with the company's cash throughout an accounting period. If we think about the other financial statements, they don't really give us a lot of information about how cash affects the business. So we have the cash account on the balance statement, but the rest of the accounts on the balance statement might just show money that we owe, money we're set to receive from customers, historical information about our property, plant, and equipment. Then we have the income statement. The income statement also doesn't really say anything about the cash that the company has on hand. Because we have different events such as appreciation that don't occur in a cash wave, net income doesn't equal the amount of cash that a company receives during the period or pays out. So we make a statement of cash flows to show the different things that happen to our cash throughout the accounting period. We have three different sections in our statement of cash flows. We have an operating activity section, investing activity section, and a financing activity section. The benefits of making a statement of cash flows that we can see a lot of information about the company's ability to pay their debts, to generate cash from their operations or what they do as a company, what decisions they make about paying dividends, whether or not they have negative cash flows and have needs for taking on short-term and long-term financing, etc. So when we look at the statement of cash flows for operating activities, we look at those things that the company uses cash for its actual daily operations. So there's a variety of examples on this slide. The money we receive from customers for our business activities, money we receive from interest or dividends if we have investments, cash payments that we pay to our suppliers, that we pay to employees, payments of interest, loan payments, anything else that we might have, such as payments of a lawsuit, litigation. Investing activities, these include our property, plant, and equipment. So our plant assets, any intangible assets. This is where our long-term assets go. So our cash receipts from selling any investments and property, plant, equipment, selling intangible assets, cash proceeds from collecting amounts on loans, and then cash payments paid to borrowers or to acquire long-term assets or investments. And then in the financing activities, this involves anything that we are doing with our stock. So if we are issuing stock or we're buying stock back, if we're making dividend payments, these also include our short-term and long-term debt. So any notes payable that we might have as a company, either short-term or long-term. So this is just a breakdown of where those cost flows go. So the operating activities section focuses on current assets and current liabilities. The investing section focuses on our long-term assets. And financing is long-term liabilities, some short-term liabilities just in the event of notes payable, and our equity section. When we talk about cash and cash equivalents, we go back several chapters when we introduced cash and cash equivalents. These are short-term, highly liquid investments. They normally mature less than 90 days from the acquisition date. They can include a wide variety of things, but they're investments that we make to earn interest on our cash instead of just having our cash sit in a bank account. Our cash information versus our accrual accounting. So we don't have, when we make our statement of cash flows, we're looking at the way that cash changes throughout the accounting period. We look at both the income statement and the balance sheet, and we look at how those transactions or things that affected the balance sheet and the income statement affected our cash flows. So we have two methods of preparing the statement of cash flows. And the first method that we're going to look at is called the direct method. So we need the income statement, we need the balance sheets, and we need any additional information that can't be determined from the income statement or the balance sheet. We always start with the operating activities section, and then the investing activities section, and then the financing activities section. The last thing we do is compute the change in our cash account from its beginning balance to its ending balance. Then we would prepare what's called a schedule for non-cash activities. The information that goes on here is information that doesn't show up in the statement of cash flows, but is important to making decisions. This is like our notes to our financial statements that we talk about. So there would just be a note at the end of our statement of cash flows or some wording that would say, we did this, but it didn't involve cash. An example of this would be, we purchased new equipment, but we didn't pay cash for the equipment. We took out a loan for the equipment, because we need to explain changes in account balances on the balance sheet with the statement of cash flows. So if we look at the balance sheet, and then we can see from January 1st to December 31st, our equipment account increased by $100,000, but there's nothing on our statement of cash flows that explains that increase in $100,000, then we need to prepare that schedule of non-cash activities that says we took out a $100,000 loan in order to pay that vehicle, to buy that piece of equipment, and that's why it doesn't show up in our financing activities section. This information is the information we're going to use to prepare our statement of cash flows and to look at our amounts. So we have the balance sheets for this corporation. We have 2017 information and 2018 information, and then we have the 2018 income statement. There is a PDF or a Word document of this that it's a little bit easier for you to see in My.Warburg that you can download along with the PowerPoint. We'll use this information to prepare the information for our statement of cash flows. What we need to do with our statement of cash flows is explain why our cash increased $35,000. So we're going to look at each section: operating activities, investing activities, and financing activities. For the operating activities section, we need some other information. So we're going to see that on the balance sheet, our accounts receivable increased by $30,000 during the year. That means that we didn't receive cash from sales. We have dividend revenue on cash basis, but interest revenue on accrual basis. We have inventory increased by $10,000 and our accounts payable increased by $15,000. And then we had prepaid expenses increased by $3,000 and accrued expenses decreased by $6,000. We need to know what our depreciation for the year is because that's a non-cash activity. We have liability for interest payable and a liability for income taxes payable. And this is all information we could see on the balance sheet also when we look at these accounts from one to another. So from 2017 to 2018, we can see that accounts payable increased $15,000. So what we're trying to explain with the statement of cash flows is the changes between 2017-18 balances to 2018 balances. Additional investing activities information. So we have marketable securities accounts changes, notes receivable changes, and plant asset changes. And then our financing activities section, we borrowed a short-term note, we repaid amounts due on our notes payable, we issued bonds, we issued shares of stock, and we have a cash dividend declared and paid to stockholders during the year. And we also show cash and cash equivalents were $20,000 at the beginning of the year and $55,000 at year end. So we're now going to look at all of the information that we have to prepare the statement of cash flows given the direct method.